ለመማር ወደ ትምህርት ተቋም መሄድ ግድ አይደለም። ናሽናል አቪዬሽን ኮሌጅ
ራሳችሁን ከኮሮና ቫይረስ ወረርሽኝ እየጠበቃችሁ በቤታችሁ ወይም በተመቻችሁ ቦታ በኢንተርኔት አማካኝነት በኦንላይን ትምህርታችሁን መከታተል ትችላላችሁ።
ካናዳ ከሚገኘው ኢንተርናሽናል ኤር ትራንስፖርት አሶሲዬሽን አያታና ከእንግሊዙ ኢንስቲትዩት ኦፍ ኮመርሻል ማኔጅመንት ICM ጋር በመተባበር የሚሰጡ ትምህርቶችን ተከታትላችሁ በ6 ወር ጊዜ በዓለም አቀፍ ደረጃ ተቀባይነት ያለውን የስልጠና ማስረጃ ባለቤት መሆን ይቻላል።
ልምድ ባላቸው መምህራን እየተማራችሁ ጥያቄና መልስ የክፍል ስራዎች ፈተና መፈተን ክፍል ውስጥ እንዳላችሁት አይነት በኦንላይን ባላችሁበት ቦታ ከናሽናል አቪዬሽን ኮሌጅ
የናሽናል ኤርዌይስ እህት ኩባንያ
in every bank's operation, because actually the government is there to take the interest of the general public, so that we avoid a situation where somebody just emerging and starting a bank, and then now he ends getting people's deposits and then running away with it, right? So the government has to come in and safeguard the interest of the savers and the borrowers, so that when you deposit your money in the bank, then at least you are assured of your money whenever you want to go and get your money at any given time. Because the bank is there to hold the money on your behalf. And then now it's a custodian of your money. But if you want to get your money, then you are supposed to be freely accessible to your money and making use of it whenever you want to. So, but you find a situation where the banks have started up, and then now, after people depositing their monies, and when you go there, you want to withdraw like your part of your money, you find you cannot be given the money, all right? So these are the situations that we are trying to avoid, or the government tries to safeguard the interests of the general public. Because once a bank is open, it's open to everybody, all right? And everybody is allowed to join to become a customer in any of the banks. So you find some people may take advantage of that, all right? So the government has to step in and ensure that at least the interest of the general public is taken care of. Issues, for example, like the minimum capital requirement, all right? Yeah. Because every bank is supposed to meet the minimum capital requirement before it's allowed to operate, all right? And that capital requirement is actually like security, all right? So that in case of any situations, then, and apart from capital, there is the minimum reserve fund, okay? The minimum reserve fund, the liquidity ratios, there's a minimum liquidity ratios for banks. So those are regulations that are set by the regulator, all right? Who is in this case the
Central Bank, National Bank of Ethiopia.
For capital markets, I can talk about capital markets for a Kenyan scenario, all right? These ones regulate the stock market. We have Nairobi Securities Exchange, all right? Where people buy shares and you are free to dispose of your shares whenever you want to. So it is done through brokers, all right? And these are registered brokers, and they are known. They are known by the central bank and the Capital Markets Authority, all right? So it's mainly ensuring that there is a proper, you know, like you would say there's proper transactions going on within the stock exchange. Because stock exchange is meant to people buying shares in case you're interested in shares of any other company. You go and place an order. Then probably you put some deposit, and when the shares are available at that particular price, the quotation that you had made, then you are given the shares, but again you pay the amount. So this whenever there is money transaction, of course you have to be careful, and this is where the government had to come in and set up the Capital Markets Authority, which regulates the secondary markets in the country. We have foreign investors, we have local investors in the stock exchange, and somebody can come from outside just to come and take advantage of the Kenyans and run away with everybody's savings, you know, or investment in terms of shares. So these are things that the government is trying to safeguard the interest of the general public and even control those companies that can be registered, because there are minimum requirements that a company has to meet before it's registered on the stock exchange, to operate on the stock exchange. When a company moves from a private company to a public company, then that company becomes registered on the stock exchange. By that movement, it means it's being open to deal with the general public in terms of raising capital or issuing shares to the general public. And again, not every company qualifies to become registered on the stock exchange. So there are those checks and balances to ensure that only qualified companies can register, because they must have been in existence for at least 5 years. Those are some of the requirements. And those requirements that on the web, you can download and read about them. Just look at the Capital Markets Authority, Kenya Capital Markets Authority, or Nairobi Securities Exchange. You will get some of this information and read about them. It's available. Okay. All right. The requirements for a company to get registered, and these are things that we can also learn from, because even Kenya started somewhere. All right, and we need to appreciate the need of stock markets, because people can freely invest and own shares and earn some dividends, isn't it? So these are means and ways of investment for the general public. Okay. Girma, is there any other concern?
No, we don't have. When do you present this case?
Yeah.
When do you present?
Present. Oh,
when?
We'll. There's an area I want to introduce. I want to introduce some of the areas like the portfolio analysis, of which we had even hinted about in our last class of corporate finance. Then now we shall open the way for presentations, so that I will give you the timings, so that everybody comes in when he's prepared or she is prepared to do the presentation.
Okay.
Yeah. Areas like the remaining areas, I will be able to handle them, all right? So that now the other areas which I've allocated to each one of you will be part of your presentations, and you need to start preparing as soon as possible, because you can see these are 4 areas, and I'll try to cover this in my part, the introductory part, the key areas. All right. For you to invest, you actually need to understand the markets. All right. And because when you are investing in the market. And when you are borrowing from the market. And when you are issuing shares, you are issuing shares to the market. So that's why market is a critical component of an investment planning process. That's why we have to understand the markets. Is there any other issue, Irma?
No.
All right. Odasia is not here.
Yes.
Melat?
Yes. Yes.
Do you have any issue about efficient markets hypothesis?
Kind of.
Yes. Which particular area?
Information about investment security, such as stock. Is efficient market hypothesis.
Now, when you talk about efficient market hypothesis, we are basically talking about information availability in the market.
Yes.
Right? Most of the decisions that we are making are based on the information that we have. And in the market, you'll find the people who are privileged to have some information and the people who are not privileged to have some certain information. So the privileged one may take advantage of the information that they have to, probably make gains or do something that, because they are informed. Information is power, generally, isn't it? When you have information, you are empowered. That's why some people are followed just because they have the information and they can give that information, which not everybody can have, okay? So the market behaves in a similar manner. When information is available or readily available, then people can make informed decisions. Like, for example, let me give you a typical example. If you are intending to buy a car, all right, the same car, assuming it is a similar car, the same brands, everything the same, in Addis Ababa, the car is going for probably $1,000. And which other town in Ethiopia that is more or less developed like Ethiopia, like Addis? Melat?
Like
Yes.
this, Mekale.
Mekale. Okay. In Mekale, the same car, you can buy the same car at at a $900 US, isn't it?
Okay.
Yes.
Yeah. So if you are in Addis and you are not aware that there is another price prevailing different from the one prevailing in Addis, in Melek, then you because you don't have the information. But if you have the information, you would go for the one in Melek because it is cheaper. You'll be saving 100 at the end of the day.
Yes.
Okay. So because you do not have that information, then you may end up spending 100 excess, isn't it? All right, which you may have saved if you had the information.
So it's
Yes,
called
yes.
Information asymmetric.
Precisely, information as when you talk about efficient market hypothesis, you are actually talking about information asymmetry, because the hypothesis says that information in the market, the participants in the market will take advantage of the information in the market to make informed decisions. So there are different types of information in the availability in the market. We have weak and weak, strong, I don't know.
Semi-strong.
There are those ones. Yes, semi-strong and all that. And then now
Trend strong.
those ones, yes, yes. And it's you can give examples. For example, assuming you are a CEO in one of the organizations and you are intending to declare dividends, then because you are aware, you can tell your friend to buy shares of that company prior to declaration of dividends, all right? Because payment of dividend or declaration of dividend, studies have shown has some positive indication on the share price of the market. So you buy a share before the declaration at 10 US dollars. But when the dividends are declared, the price is bound to shoot, isn't it? So the price shoots to 15 US dollars. So you will find that if you can buy and accumulate those shares, then you'll have those shares and then sell them after the declaration. You see, you'll have made some gains, isn't it? Just making gains by just sitting like that, yeah? Because you had the information which not everybody had, isn't it? So their information availability in the market is very important. And you find in the most developing countries, we have that problem of information availability in the market. Unlike the Western countries, information is readily available. Companies publish their statements. Though there is also some level of asymmetric information in markets. So that's what you need to look at, because as a manager, despite the fact that you've made a decision to dispose or to sell shares or to borrow, okay, then are you using the right information that is current, all right, or you are using historical information? Markets are keep on fluctuating. Information keeps on fluctuating in the market every now and then. That's why in the stock exchange, the updates are timely. Every minute there is an update on the pricing. Every minute is, and if you can see like the behavior of purchasing and selling of shares in the market, demand and supply of shares in the market, then you'd see that behavior occurring, and which actually tells you, can help you in making some certain decisions. And that is what is required of you as a manager. So you need to be appraised with all current information that is prevailing in the market for you to make informed decisions. That's what we're talking about efficient market. Any other question, Kema? Malat?
No, sure.
Then we have Kadir. Kadir is not there. He's not yet joined.
Yeah.
So you said we have another colleague joining us.
Yes.
Who is that?
Mabit.
Huh?
Mabit.
Mabit Naga. Girl which is in the previous class.
Girma, can you type his name or her name? So
Mabit
Mabit Nagari.
Nagari?
Yeah.
Okay.
Nagari.
Mabit Nagari, yes.
So I'll need to allocate him one of these areas so that he can handle that, okay, as part of the coursework. Okay, that was about the topic allocations. And for you who are here, if there's any other clarification that you may require from here, just feel free to air out so that we can be sure of what is expected of us.
Okay.
All right. Let's hope they will join us along the way. But I just wanted to make some clarification on these areas so that as we continue, you can also start preparing yourselves for these areas so that when the time comes, we are able to address them adequately. Otherwise, the rest of the stuff are okay according to what I may say. We have addressed the ratios and we need now to probably relate the ratios and financial planning, because when we talk about investment analysis, we are basically talking about how we select projects, how we select the sources, and therefore that is part and parcel of financial planning, because you plan on where you're going to invest and where you're going to source the funds to do your investment. We have different types. We have long-term, short-term, and all that, as we saw in our previous class. That was corporate finance. So allow me now to share the other bit. Okay, can we read this? Are we able to see this?
Mm-hmm.
Investment analysis and portfolio management summary guide on lecture notes. Now,
Okay.
this is what is going to guide you on the areas that you've been allocated. For example, markets. Girma, you'll have to look at the financial markets. They are designed and to allow corporations and governments to raise new funds. So basically, you look at the functions of the markets.
Mm-hmm.
As you can see, this is a guide, all right?
Mm-hmm.
Basis for classification of financial markets. And we have said we have basically two types of financial markets. We have the money markets and the capital markets. So the classification can be based on several factors. We have primary and secondary. We have the participants and all this kind of debt and derivatives, you know. And you can see I've given a summary of what you need to look for whenever you are discussing under this basis of capital classification, basis of classification of financial markets. And basically that, because we need to understand, to appreciate why markets are there and what we can get from markets as managers. One, because we can't operate in isolation. We have to operate within a market, all right? So there's always an interaction between our organization and the general market. So there are means and ways of interacting with these markets. And for us to do well in the market, then we have to understand the market, all right? And just like I said, market variables keep on fluctuating in every, unless we have legal controls. Like when the government controls the interest rates, then those are bounds. But when it's open, where there is the demand and supply forces are open, an open market, then you'll find that these variables are bound to change every now and then. So we need to be appraised with all these areas so that we are able to make informed decisions and which may affect our planning, financial planning processes. Melat, you're looking at market efficient theory, all right? Basically, it's market efficient theory. It's about the price, and price is dictated by the information that is available in the market, all right? How would you determine the price of a share, isn't it? And just from the examples I've been giving, like if I'm aware that this organization is going to declare dividends, then I can fix my price at any time, any value that I feel is okay, and of which is going to give me a gain, isn't it? So these are some of the things we are talking about. Information is a critical variable in the pricing of securities in the market. Securities can be shares, it can be bonds, it can be, name them, isn't it? And many other securities. There are those key terms, and there are those efficient theories that you can talk about, like past information, current information, as well as events. Those are issues that affect the market. You'll also talk about the capital market efficiency, all right? And this basically talks about the shares, pricing and all that. Then there are basically three forms of market efficiency. And we have weak, semi-strong, and strong form of efficiency. So when I give you that area, I expect you to talk about and highlight some of these areas, which I've actually outlined in this summary guide. Is that okay, Melat?
Yes, sure.
Good. So the other areas that we shall address, like for example, the types of investments, we have security markets, we have the types of investment, we have individual investors, different types of investors, institutional investors. It can be an institution, it can be an individual, all right? An institution is an organization. For example, if you are a manager of an organization, then you have to make decisions on behalf of the organization. So, for example, if it's a corporate entity, then that becomes an institutional investment because it's the organization that is going to invest. You can also make these decisions at an individual level because you look at the market, scan the market as an individual, and then decide which is the right investment to make at any given time. Then we have financial investments. These involve contracts in paper or electronic form, such as stocks, bonds. When you buy a stock, you are doing, that's basically financial investment. When you buy bonds or treasury bills, that's basically financial investment. As opposed to a physical investment where you're buying land. Because if you buy land, that is a non-financial investment. But you can also, like when you put your money in a fixed deposit, that's a financial investment because you end up earning interest, right? That interest is a return on your financial investment because you end up getting back your principal, and then over and above that, you also get your interest. You earn your interest or your dividend. Like when you buy a share, buy a share, you have your capital, your initial investment intact, and then now you earn that dividends over and, because of your investment. So that is a financial kind of investment. Investing versus financing. Investing could be associated with different activities. but the common target in these activities is the employee, the money. So we in our initial class of corporate finance, we looked at investing decisions as well as financing decisions. So investing decisions is actually trying to evaluate projects so that you come up with the right project to invest in. When you talk about financing decisions, is actually trying to look for the right source of funds to put into your investment. This is basically a long-term kind of investments. So
በትምህርት ከፍ ብሎ መብረር ይቻላል። ናሽናል አቪዬሽን ኮሌጅ የናሽናል ኤርዌይስ እህት ኩባንያ ከከፍተኛ ትምህርት አግባብነትና ጥራት ኤጀንሲ ሙሉ ዕውቅናን ባገኘንባቸው በማስተርስ ዲግሪ ኤምቢኤ በስትራቴጂክ ማኔጅመንት፣ ኤምቢኤ በባንኪንግ እና ፋይናንስ፣ ኤምቢኤ በቢዝነስ ሊደርሺፕ፣ ኤምቢኤ በሪስክና ኢንሹራንስ፣ ኤምኤስሲ በኢንተርናሽናል ትሬድ እና ኢኮኖሚክስ ዘርፎች በእውቀት ለመቅረጽ የበቁ ፕሮፌሰሮቻችን አረንጓዴ መብራታቸውን አብርተዋል። በነገራችን ላይ በኬንያ ሀገር ከሚገኙ ስመጥር ዩኒቨርሲቲዎች በሚመጡ ፕሮፌሰሮች የትኩረት መስክ ትምህርቶቹ መሰጠታቸው ልዩ ያደርገናል። በምርጥ የትምህርት ስርዓት የተገነባው ናሽናል አቪዬሽን ኮሌጅ በመጀመሪያ ዲግሪ በአቪዬሽን ማኔጅመንት፣ በሆቴል ማኔጅመንት፣ በአካውንቲንግና ፋይናንስ፣ በማርኬቲንግ ማኔጅመንት አስተማማኝ ትምህርት ይገቢውና ራስዎንና ሀገሮን ይለውጡ። አድራሻ 22 አደባባይ ወደ ሾላ በሚወስደው መንገድ ላይ ናሽናል አቪዬሽን ኮሌጅ የናሽናል ኤርዌይስ እህት ኩባንያ ህልሞን እውን ያደርጋል።
It's actually important that when we are making this kind of decisions, we are basically looking at the expected returns because the end goal of making investment decisions and sourcing decisions or financing decisions is to maximize shareholders' wealth. So shareholders' wealth can be maximized through increase in share price or profitability of the organization. So this is why we have to make such decisions, and we ensure that the decisions that we make are going to end up increasing the shareholders' wealth or profitability rate increasing. We have direct versus indirect investments or investing. So we can use direct or indirect investing. Direct investing is realized using financial markets, and indirect investment involves financial intermediaries. Direct is like, okay. For example, you can see the table down there, direct investing, raising equity capital or borrowing in financial markets. And then indirect investing through financial institutions, borrowing from financial institutions. That is indirect. Okay, now the clear difference between the two, direct and indirect, is direct is when you go directly to the market, okay, and probably borrow, all right, or invest. And indirect is where you go through an intermediary. Like banks are known to be intermediaries because they borrow money from the, okay, they hold money from their depositors, okay, people who are saving with the bank. Like if you have some money, you go and deposit it in your account, then you make the bank have funds that it can lend out to the borrowers. So a bank is acting like an intermediary between you who is saving and the other party who is borrowing. Because if I was to borrow directly from, assuming I can as well go directly to Girma and ask him to borrow me some $100, isn't it? So he will give me the $100, or to lend me the $100. Sorry, to lend me the $100. He will simply give me the $100. But I can as well go to the bank and Girma deposited the money that he had, the $100, to the bank. So I can as well go to the bank and borrow the same $100 from the bank. All right. So now I will be owing the bank. Okay. And Girma will have saved with the bank. So the bank is acting like an intermediary. Probably I would not have known that I can as well borrow from Girma because probably I did not know him, isn't it? Well, I didn't know that I can as well approach him to give me. So, but when I go to the bank, because the bank is there to provide these two services, then I'm able to borrow from the bank. So that is indirect investment or indirect borrowing. Now, when Girma is saving with the bank, he's investing with the bank. Because he's saving with the bank will pay him some interest because of the savings. Okay, the bank will pay him some interest because of the savings. And when I'm borrowing from the bank, I will pay some interest to the bank because of borrowing from the bank. Okay, so it can be looked in either way. It's borrowing, all right, or investing, because when you save, you are investing in the bank because you end up earning some interest, all right, because of the savings. But when I'm borrowing, I end up paying the banks the interest because that interest is actually because of my borrowing. So this is an indirect investment or borrowing, which is actually can be looked at as a way of financing and a way of investing. So the types of investments, we have investment environment, this is the existing investment vehicle in the market available for investor and the places for transactions with these investment vehicles. So we have different types of investment vehicles. We have short-term investment vehicles. Short-term is like the example I've been giving, where you are just saving with a bank, and then you can put your money in a fixed deposit so that you earn some interest. So that is a short-term kind of investment vehicle, where you have money on your savings account, and then now the bank pays you some interest. Then we have fixed income securities or common stock. This is where you can probably buy bonds or even give a loan to buy a bond or a debenture, isn't it? A debenture, where you are assured of getting some interest every year. So it's a fixed return kind of investment, because the company is bound to pay you every year in terms of interest because of the bond or the debenture you hold with them. We have speculative investment vehicles. Speculative is actually like it's most common in lands or even shares. When brokers are buying shares, they are speculative in nature. How is land preferred, or how is land? Because in Kenya, land is very valuable thing in Kenya. One can buy land, like in Nairobi. If you buy land today, after 2 years, if you are to sell the same land, you will sell it at probably double the price that you bought it. How is it in Ethiopia, Girma?
Yes, it is, yes. Here in
It's the
Addis,
same.
in here Addis, it is
Yes.
expensive, too much expensive.
Yes. And it appreciates
The,
in value.
the return is very, very,
The
yes,
return
it
is very
appreciates.
high.
Yes,
Yes.
yes.
So
individuals
yes.
are trying to invest in the land areas.
Yes.
Housing
So
and land.
yeah. So somebody can just specialize in investing in land, so that he buys land here, he keeps it for 2 years or this number of period, and then he disposes he disposes it off, because it's always in demand, isn't it? It's always in demand, and it will appreciate in value. So that is speculative, isn't it? That's speculative kind of investment. Brokers can buy shares, keep them, all right? Keep them. After some time, when they have information that these shares are likely to rise in value, they dispose the shares, and then they make gains on that. So those are kind of speculative investment. So you can easily see the types of investment we can talk about. We have like speculative, like pension, life insurance, hedge funds. Like hedge funds are, they are mostly found in the money markets, or in the when there is an exchange of when you are forex, in foreign exchange, where you are operating abroad, so you have to interchange the money, the currencies. So there's an exchange of the currencies. So you try to hedge your currency against some risks or fluctuation risks, so that you see, you are speculating that next contract, probably the price may have changed, or the value of the dollar may have changed, isn't it? So you are speculating so that you have to guard yourself against that risk of the changes in the currency. Pension funds, the same, yes. You are keeping your money so that you are saving for future investment, for future returns, just like land, isn't it? So that you save, and then the pension organization or fund, they invest that money, earn some interest, and that interest makes you get even more when you are retiring after your employment, and then they can keep paying you your benefits. Life insurance, they also have the people pay funds, they pay premiums, and then now the organization can invest the money elsewhere, but when the risk occurs, they are compensated. But you find, if the risk does not occur, you find that is an earning for the investment. We had talked about markets, and this is an area that is being addressed by Germa. Now, investment management process. Investment management process is a process of managing money or funds. It describes how investors should go about making decisions about investment. And there are 5 key steps that are involved in the investment management process. One, the setting of investment policy. You have, as a manager, you have to set an investment policy. And look at some of the samples of investment policies, all right? For example, if it could be an investment should give a minimum return of probably 10%, isn't it? So that is a policy. So when you are evaluating projects, you have to select those ones that are giving you at least above 10%. That's the organizational policy with regard to investment. So that one has to be set. Then there is the analysis and evaluation of investment vehicle. You need to analyze, like we have seen the investment vehicles. We have short-term, we have the fixed deposit and all this, the speculative. So you need to analyze them and evaluate, all right? So analysis and evaluation is actually critical for managers because this is where now you select the right one that is going to meet your objective, which is part of your policy. Because they have to be looked at in those terms. So an evaluation and some of the processes we looked at when you are looking at the decision that we make as managers, like for example, investing, we looked at capital budgeting. You have to look at the capital budgeting in terms of NPV, present value, profitability index. I hope you remember all those stuff. Huh?
Yes.
Yes. ARR and all the profitability index. So all those can play around. You can play around with them so that you can select the right project to invest in. Then we have also the portfolio analysis, which now actually is an area that we need to look into detailed about this course. We have also the next stage, which is formulation of diversified investment portfolio. So this is about selecting the combination, the right combination. You know, you can have a number of projects all promising, they are doing well, but when it comes to combination, they cannot combine. So the whole idea about portfolio formation is about how well the investments, the projects can combine, all right, to maximize the returns and minimize the risks. So that's portfolio analysis. Then portfolio revision. Now this is where we because it's a portfolio and we are more concerned about the combination, you find one project within the combination along the way may not work with the others. So you have to keep on revising. What do we do with this one that is not able to combine with the others? And alongside our discussions on the analysis of our portfolio, we said we have indicators that can tell which project is not combinable with others. For example, the correlation coefficient. When you see it is positive, then it means this project cannot combine with the other. When it's negative, and then you evaluate each project on an individual basis, and you can always get which project is not viable for a proper combination. Then the measurement and evaluation of portfolio performance. Now, we can also measure and evaluate the performance of a portfolio. And I'm assuming at this point we understand what a portfolio is. So we have models that you can use. And some of these models have been put across by some of the renowned researchers, like for example, Sharpe's ratio. So how do we compute the Sharpe's ratio, all right? And how are we able to interpret that in relation to the portfolio? Because this will tell us more about how we can revise the portfolio. We have trainers ratio, all right? We have trainers ratio, and we have Jensen's alpha ratio. Now, these are ratios that can be used. Like just when we are looking at dividends, we looked at Gordon's model, we looked at Walter's model, we had MM's model. So there are all those models that explain the dividends. Just like portfolio here, we have these other ratios or that measure the performance of a portfolio. And we have the Sharpe's, we have trainers, and the Jensen's alpha model. So these are models that we are going to look at so that they can help us evaluate a project and make a portfolio and make informed decisions. Then portfolio theory and analysis. This is where now the main stuff is. And actually, as we saw in our corporate finance class, it is a whole area that needs, that calls for an evaluation of different projects. So we shall look at, basically we shall look at the returns. How do we determine the returns of a portfolio? Not a portfolio, but an individual project or an investment. How do you evaluate risk of an individual project? And then how do we evaluate the return of a portfolio? How do we evaluate the risk of a portfolio? So all this will be looked at under here. And then we have the other models, like the other approaches, like the capital market line, the capital asset pricing models, the SML model, and we have different equations that you can use to evaluate projects based on these models. The CML, the CAPM, and the SML, all right? We shall also look at because one addresses a combination of a portfolio where we have the risk-free assets and the riskless assets. Sorry, the risk assets and the riskless assets, all right? How do we address that, all right? In our portfolio, initial portfolio analysis, we're going to use standard deviation as a means of measuring risk because it measures the deviation between the actual return and the expected return. So those deviations are averaged to determine the risk of getting a certain return. And of course, using probabilities. But in a riskless market, in a riskless investment and a risk investment, we have beta. We use beta to determine the risk of a project. And this is where now we're going to be looking at these other models like the CAPM and the SML. Yes, we shall look at the advantages and disadvantages of each of the models. Because as we saw in, for example, in ratios, every model has its limitations and its strength. So as much as these models are there, they help us evaluate projects. They have their weaknesses and they have their strength. So it's also important that we understand that. Efficient market theory, we had talked about that, and that is Melat addressing that. And I think we had cleared with that. Investment in stocks. Now, we have common stock and we have preferred stock. Preferred stock are the preference shares, and common stock are the ordinary shares, all right? As we know from our accounting background, So we need to understand this kind of stocks and how we can analyze investment in this kind of stocks. Like how do we analyze investment in shares? How do we analyze investment in preference shares? Because they have different characteristics. Preference shares are have a fixed rate of dividends, and ordinary shares have a fluctuating rate of dividends because you may be paid. They are dependent on the declaration by the managers or the directors if they are to be paid or not. So it's not automatic that you be paid some of these returns on such investments as opposed to preferred. So there are those approaches that we use. And we have the top-down approach and the down-top approach. We shall look at those approaches that we can use to make such investments. So you need also to analyze the EIC. You need to carry out the EIC analysis, the economic, the industry, and the company, all right? Because as I said, companies do not operate in isolation. They operate in an economy or in a market and in an industry. So there are those industry regulations, there are those market regulations, there are those company regulations that we have to observe. As much as we are doing this in decisions or evaluating projects, then we have to be keen about some of these provisions that are there for us to do well in the market. So these are some of the things that we look at. The EIC is actually very important, as I had said. It's actually it's coming from the idea that as a company we cannot operate without the market, and actually it relates to what I told you earlier on about understanding the market. So these are some of the analyses that you have to do in relation to the investment project that you are evaluating. We will also look at the stock valuation process and decision making. How do you value stock? All right, stock valuation. I don't know whether we looked at this when you're looking at the corporate finance, but if you recall, when you're looking at the cost of, for example, the ordinary shares, there was an element of PO meaning the price. So if you make the PO the subject, then you are looking at the price, the valuation of the stock. So these are some of the things that probably we just give handouts to go through, because they actually remind us of what we looked at when we were looking at some areas in corporate finance. Strategies for investing in stock. There are so many strategies, all right. We have sector rotation and business cycle strategy. We have market timing strategy, value screening strategy, sector rotation and business cycle strategy. These are things that you can read about. Okay. Yeah, it's important. That's why I gave you this, so that you read about some of these strategies and be able to explain them. Okay. Be able to explain them. Like, for example, market timing strategy is like more or less like speculative. You know, you are anticipating price to go up, and therefore and when it goes up, that's when you dispose of so that you make some gains. You need to read about this so that we'll be able to be together as we go on discussing this and when we talk about some of these issues. Then I have explained briefly about this here. Then we'll also look at investment in bonds. Bonds are have a fixed rate of return. Of course, at the issuance, you're already sure of the return that you anticipate to get. Probably could be quarterly or semi-annually or annually, right? Depending on the agreement between the lender and the borrower. Okay, so it's important that we understand this, the advantages and the disadvantages of investing in bonds, right? So these are some of the things that make you well understand the market, so that as you make decisions as a manager, you will be more informed when it comes to the source of funds that you need to raise. Is it through issuance of bonds? Is it through issuance of shares and all that? So bond analysis, structure and contents, market interest rate analysis, all right? Bond valuation and investment decisions, strategies for investing in bonds. Just like we saw the strategies for investing in shares, there are also strategies for investing in bonds. What are some of these strategies? Okay, so like for example, buy and hold strategies. You buy bonds and then hold, and then when the demand increases, you dispose of and make some gains. So the important strategy is to choose the most promising bonds that meet the investor's requirements. So every investor, of course, has its own requirements, but the bottom line is maximizing on the returns. Then we have derivatives. I know one of us is going to address the issue of derivatives. These are financial markets derivatives. They are financial instruments, basically. Like we have contracts, futures, options, and it's mostly practiced by people who are in the international trade, where we have differences in the currencies. Like you're dealing in dollar, the other one is dealing in pounds. So there is always the issue of trying to minimize the risks of dealing internationally and also maximizing the returns by dealing internationally. So there are those measures that we put in place to safeguard ourselves from the high risks that may come about because of our international trade. Okay, so these are some of the measures that we put in place. And then now, how do they operate? Because, for example, if it's a contract, a future, how does a future operate? And there, how many types of futures do we have? We have swaps and all this. So you need to read about this so that we are able to understand this and be able to apply them in making our decisions as managers. As an organization, I said you deal with the market. And when you are dealing with the market, it can be local market or international market. So when you are thinking about international market, then there are those issues that you may consider than if you're dealing with a local market. Because local market, you basically operating in the same currency, isn't it? So, but when it comes to international market, then the issue of currency comes in, the currency devaluations and all this have to be considered. The exchange gains and the exchange losses, they're there, okay? Because the fluctuations in the currency are happening in the market because of demand and supply forces and so and other factors. For example, which factors do you need to consider here? Like if, for example, if it's a political kind of factor, like in cases when we have elections, you find the currency of the country having elections is bound to increase because to devalue, because there's no demand for that currency. People don't want to go to that country, all right, because of fear of the unknown. But you find in a normal scenario, people like in Kenya, tourists may want to come, and then there'll be high demand of the Kenyan currency because when they are here, they are bringing in a lot of dollars, and then now they are purchasing the Kenyan currency. So you find the Kenyan currency becomes on high demand, and therefore the dollar devalues in value. So this is actually the scenario that actually is happening in the market, and you need to be aware of this.
I think
and
it's doctor.
Yes.
I think the derivative are assigned to Kadir. He is now joining us.
Kadir.
He's us.
Okay.
He's with us.
Yes. Kadir, how are you?
I'm fine.
Kadir, welcome. You've joined us late.
Yes, doctor, I'm fine. Yes, I'm going to way long distance.
And you are not coming out clearly. Hello, Kadir, you're not coming out clearly.
Yes.
You are breaking. You're breaking.
Yes, sir.
Yes. Hello.
Yes, sir.
Huh?
I listen you.
You're okay. You're listening.
Listen. I listen.
Okay. Did you see whatever I had sent you last time?
Since
Do you know the area you are supposed to address in terms of your presentation? Kadir? When I send you the course outline.
I hear.
Okay. Which area are you supposed to address?
Research. Hello, doctor.
Yes. Hello. Yes.
Yes, doctor.
Yeah.
I hear.
Girimak, are you getting what he's saying?
I think there is a disturbance. Huge noises.
It's breaking, and I can't get clearly what he's trying to say.
Yes.
Malat, are you getting what he's saying?
No, his network connection is not good, I think.
Okay.
Fine. Let him as he continues to find ways of joining us. I think we should just continue with where we are. Now, so these are the areas that we need to be clear about, and I gave you this so that you need to read about them and get yourself familiar with these areas. They are very important and very informative in terms of making the right decisions, all right, when it comes to deciding on the investment and the borrowing. Portfolio generally is an investment kind of decision-making process. And so last time when we were looking at corporate finance, we looked at the four, all of the four. But here we're going to dwell on this. And now the relationship between this and the ratios that we were looking at last time. Ratios, as we said in our last discussion, it gives more about the organization's performance. Because if you are to make a decision about investing, then you must also understand what is our financial position as the organization. Are we profitable or we are not profitable? Because if you are thinking about diversifying your investment, then you must be in a profitable state, isn't it? Because if you are not in a profitable state, then you cannot diversify your investment. So one of the informative means of making these decisions is through doing ratio analysis, because it gives you about the status of the organization in terms of its weaknesses, in terms of its strength, and in terms of its financial performance. And which is actually the bottom line about investing. You cannot invest what you don't have. You know, you must have the excess so that you think of investing. You have to meet your basics first. Then after meeting your basics, that's when you can think of investing the excess. I think that's a common knowledge. So how do we know that we have some excess that we can invest? It's through the ratio analysis. And that's why it's important that managers are able to analyze the performance of the organization in terms of using this model, the ratio analysis, as we looked at last time. Okay, any question before we proceed? Any question, comment?
No, doctor. I'll continue.
Okay, Melot? Kadir? Is still not yet clear? Okay. Now, there was the second illustration, which I sent you. Did you try solving some of those ratios?
No.
No?
On my behalf, no.
Okay. Why?
Because I'm too busy this week.
Too busy this week. Okay. Melat?
That's a
No.
Yeah, but do you have the necessary formulas that you need to address? I just wanted you to test working on that one.
okay.
And then so that when we meet, we can see where probably you need to correct in case we are not getting the right or the same answers and the same interpretation. So probably between now and tomorrow before we meet, you can take time to just go through that illustration 2,
Okay.
so that we look at it, because after that we shall now move on seriously to this area of investment analysis and portfolio management.
Okay.
So try to just go through that, and then if there are any issues we can raise tomorrow as we go together, so that we can clear some of these things before it's too late.
Okay.
Okay. Any comment, question? Manad, you have a question, comment?
No.
Okay. So I think for today we can stop there. So take time to go through the second illustration for our tomorrow's discussion, and then after that we'll embark on portfolio analysis, and try also to revise on your corporate finance areas that we had looked at last time. Like, for example, the determination of return of a project, determination of risk of a project, determination of return of a portfolio, and determination of return of risk of a portfolio. Because that is actually some of the critical areas we shall be looking at. Because once you understand that, when we move to CAPM and the APT models, we'll be able to understand them without any problem. Otherwise, thank you for turning up.
ልዩነት መፍጠር ዓላማችን ነው። ዓለም አቀፍ ተወዳዳሪ መሆን አለባችሁ። የናሽናል ኤርዌይስ እህት ኩባንያ ናሽናል አቪዬሽን ኮሌጅ ጥራትና ደረጃውን የጠበቀ ስልጠና በመስጠት ብቁ ዜጋ እያፈራን ነው። በፍላይት ኦፕሬሽን፣ በበረራ መስተንግዶ፣ በቲኬቲንግና ሪዘርቬሽን፣ በሆቴልና ቱሪዝም ሙያዎች አሰልጥነን ተወዳዳሪ እናደርጎታለን። ኮሌጃችን ካናዳ ከሚገኘው ኢንተርናሽናል ኤር ትራንስፖርት አሶሲዬሽን አያታና ከእንግሊዙ ICM ጋር በመተባበር ዓለም አቀፍ ዕውቅና ያለው ስልጠና እየሰጠ ይገኛል። በፍላይት ኦፕሬሽን፣ በበረራ መስተንግዶ የምንሰጣቸው ስልጠና ከኢትዮጵያ ሲቪል አቪዬሽን ባለስልጣን ሙሉ ዕውቅና አለው። አድራሻ ከጎላጉል ታወር 22 አደባባይ ወደ ሾላ በሚወስደው መንገድ ላይ የናሽናል ኤርዌይስ እህት ኩባንያ ናሽናል አቪዬሽን ኮሌጅ ህልሞን እውን ያደርጋል።